If you think gold and silver prices move freely based on supply and demand, you are badly mistaken. What is happening in the precious metals market right now has very little to do with real metal. It has nothing to do with miners, nothing to do with solar demand, nothing to do with jewelry, and nothing to do with economics. It has everything to do with a crime scene. Over the last 72 hours, we have witnessed a coordinated, highly sophisticated attack on the silver price. On the surface, the mainstream financial media will tell you this is a healthy correction. They will tell you the market is overheated, that traders are taking profits, and that this is just the normal ebb and flow of commerce. But underneath, the structure of the market is extremely fragile. We are seeing a desperate attempt to manipulate the price through paper contracts, leverage, and secret exchange rules designed to do one thing: protect the banks and crush the retail investor. Silver didn't fall because the planet discovered a new ocean of supply. It didn't fall because solar factories shut down or EV demand vanished overnight. Silver fell because the rules changed. A margin hike hit the futures market, and it forced liquidation, fast, ugly, and automatic. Last week, silver ran into the mid-80s. Then, right as traders came back from the weekend, the exchange increased how much cash you must post to hold certain silver contracts. Let's strip away the noise and go straight to the trigger mechanism. You need to understand exactly how this weapon works because it is the primary tool they use to steal your wealth. A silver futures contract is a leverage tool. One contract represents thousands of ounces, but you don't pay for those ounces up front. You post margin, a fraction of the full value, as a performance bond. It is the exchange saying, prove you can survive volatility. It is a test of your liquidity, not your conviction. But recently, the exchange changed the requirement. For silver, margins were raised first from around 22,000 to 25,000. That was the warning shot. Then, aggressively, they raised it from 25,000 to 32,500. That is roughly a 30% jump in the cost to hold your position, implemented in just 3 days. Imagine if your mortgage bank called you today and said, you need to put down another 30% cash on your house by 5 p.m. or we are selling it. That is exactly what happened to thousands of traders. If you were long with leverage, you woke up owing more collateral immediately. Pay it, or your broker sells you out at whatever price the market will give in that moment. That is what happened. Not a mystery, not a macro shift, but a margin squeeze. When thousands of leveraged traders are forced to sell at once, you don't get orderly price discovery. You get a stampede. The sell button isn't being pressed by conviction or analysis. It's being pressed by necessity. That is why these drops look like cliffs. A normal pullback has buyers stepping in, sellers testing levels, and price breathing. Forced liquidation doesn't breathe. It falls until the forced sellers are done. And the timing matters. It always matters. This margin increase hit during a thin year-end stretch when liquidity is often lighter. A lighter liquidity means the same amount of forced selling hits harder. It means stops get triggered more easily. It means a cascade can build faster than people can react. So here's the first lesson. In silver, you're not only trading the metal, you're trading the rules around leverage. Most people learn that the hard way. Let's get more concrete because margin sounds like a boring footnote until it reaches into your account and takes your money. There are usually two numbers that matter: initial margin and maintenance margin. Initial is what you need to open and hold. Maintenance is the minimum you must keep to avoid a call. But when volatility spikes, those numbers can jump fast. And when they jump, they don't hit everyone equally. Big institutions can post collateral quickly. They have credit lines and treasury desks. They can move money in minutes. Smaller traders can't. Retail traders can't. A lot of people can't wire fresh cash instantly, especially during a holiday stretch when banks are slow and approvals take time. So the market doesn't liquidate the wrong crowd first. It liquidates the least liquid crowd first. That's why these events feel unfair, because structurally, they are. Now, watch the chain reaction. Price dips. The dip trip stops. Stops become market sells. Market sells push price lower. Lower price triggers more margin stress. More margin stress forces more liquidation. It's a self-feeding spiral. In futures, that spiral can represent an absurd amount of paper ounces trading in minutes, not because that much metal moved, but because that many claims moved. And since the futures price is the benchmark, the claims can drag the screen price lower even if the physical market is unchanged. What is critical to understand is this. Gold-S volatility did not spike enough to justify these margin hikes. So this is not about risk control, it is about price control. By forcing liquidations, selling pressure appears. That helps relieve pressure on large short positions without those shorts being liquidated themselves. In simple terms, margin hikes act like a hidden bailout for trapped players. We have seen this before. We have the receipts. In 1980, during the Hunt Brothers era, silver went parabolic. Then the rules tightened. Restrictions and margin changes hit. The rally broke. The story became a cautionary tale about greed, but the mechanism was mechanical. In 2011, silver surged again, volatility spiked, and margin requirements were raised repeatedly in a short span. Each hike forced some traders out. Each forced exit added fuel to the next drop. It wasn't one sell-off. It was a sequence of squeezes. The pattern is very clear. Even when the macro backdrop supports higher metal prices, structural tools can be used to cap rallies and reverse trends. But there's a second layer to this manipulation that goes deeper than just the margin hikes. It involves the biggest banks on Wall Street and a regulation you've probably never heard of, but one that is currently dictating the value of your portfolio. They made a mistake, a massive multi-billion-dollar calculation error. For the last 48 hours, the largest banks have been engaged in a desperate mission to smash the price of silver. Their goal was simple: smash the price of silver. They wanted to drive it down before the year-end close. They wanted to trigger the stop losses. They wanted to break the spirit of the bulls. And for a moment, it looked like they succeeded. They pushed the price all the way down to $70.50s. It looked like a crash. It looked like the end of the rally. But then something happened that wasn't in their script. The selling stopped. The price bounced. And right now, as we head into the final hours of 2025, silver is trading back up. We are seeing a dog G candle on the daily chart. That is a sign of indecision. It is a sign that the selling pressure has been exhausted. The banks threw the kitchen sink at this market, and the market absorbed it. By smashing the price, they didn't kill the rally. They unwittingly created the greatest buying opportunity for their competitors. They lowered the price for China. They lowered the price for Samsung. They lowered the price for the very entities that are draining the vaults. In this deep dive market analysis, we are going to expose the bank trap. We are going to explain why the drop to $70 was a regulatory flush driven by year-end accounting rules, not by market fundamentals. You need to understand why they attacked right now. It wasn't just about the price. It was about the GSIB surcharge. This stands for Global Systemically Important Banks. Under the Basel III regulations, the biggest banks in the world are scored on their systemic risk at the end of the year. The score is calculated based on a snapshot of their balance sheet on December 31st. If the score is too high, they have to pay billions in extra capital requirements next year. So every year in late December, the banks have a fire sale. They sell assets, they close derivative positions, they shrink their book. They are not selling silver because they think silver is going down. They are selling silver because they need to be cash heavy and asset light. It is a regulatory hallucination. They are pretending to be smaller than they are to fool the regulators. But here's the catch. On January 2nd, the snapshot is over. The regulations relax. The banks can go back to normal business. And what is normal business? Trading, hedging, buying. So the selling pressure we saw yesterday and today is artificial. It has an expiration date. That date is tonight. Once the ball drops, the GSIB pressure vanishes, and the natural forces of supply and demand take over again. This is why the drop to $70 was a bear trap. It lured retail traders into selling at the bottom. You hear people say, "Oh no, the banks are dumping." No, the banks are dressing the window, and tomorrow they will change their clothes again. If you sold yesterday because of this regulatory flush, you got played by the accounting department of JP Morgan. To understand why this was a mistake, you have to look at the floor. $70, this was the breakout level from weeks ago. It was the ceiling that held us down for months. When we crashed yesterday, the price went straight to $70.50, and then it hit a wall of concrete. It didn't go to 68, it didn't go to 65, it stopped dead. This tells us that there's a strategic bid sitting at $70. There are buyers, industrial buyers, sovereign buyers who have automated orders to buy everything at that level. The banks tried to push it lower to trigger a panic, but instead of panic, they found liquidity. They sold their cheap silver to strong hands. They transferred ownership from the paper speculator to the physical accumulator who buys on value. This is a fatal error for a short seller. You want to cover your shorts by buying from weak hands. You do not want to sell your shorts to strong hands because strong hands do not sell it back to you. They take it off the exchange. They melt it. They vault it. By driving the price to $70, the banks accelerated the drain of physical inventory. They made it cheaper for the world to take the metal away from them. Let's look at the volume profile of the recovery. We are currently trading higher, recovering nearly $1.50 from the lows. The chart shows a long lower wick. In technical analysis, a long lower wick is a sign of rejection. The market went down, looked at the lower price, and rejected it. It said, "No, too cheap." This rejection is happening on the last day of the year. This is critical. It means that despite all the pressure, despite the tax selling, despite the GSIB liquidity flush, the market wants to close the year high. It wants to close above $70. This preserves the bullish trend on the monthly and yearly charts. As long as we stay above $70, the chart damage is minimal. It is just a flesh wound. The structural integrity of the bull market is intact. Now, I want to prove to you that this price drop was fake using undeniable data. We have to look at the arbitrage gap between New York and Shanghai. This is the smoking gun that exposes the manipulation for what it is. While New York was crashing to $70, what did Shanghai do? Yes, Shanghai dropped. It fell from $82 to $75.58, a massive drop. But look closely at the spread. New York is trading around $71.83. Shanghai is at $75.58. The difference is roughly $3.75. Even after the crash, silver is still nearly $4 more expensive in China than it is in the United States. The arbitrage gap did not close. It narrowed, but it is still wide enough to drive a truck through. This means the sucking sound is still there. Metal is still flowing from west to east. The banks smash the paper price, but they cannot smash the physical reality that China needs metal. As long as that premium exists, the floor under the US price is solid. We cannot go to $60 if China is paying $75. The arbitrage bots won't allow it. Let's also look at the gold anchor. Gold is trading at 4,146. It is down marginally. But compared to the volatility in silver, gold is a rock. Gold is holding the line. It is refusing to break down. This tells us that the monetary premium is still active. The world is still worried about debt. They're still worried about currency debasement. They are not selling their insurance. They are just adjusting their hedges. Silver, being the high beta asset, swung wildly. It dropped 10% while gold dropped 1%. This is normal. This is the nature of the beast. But because gold held, silver has a safety net. Silver cannot collapse if gold is at all-time highs. The ratio prevents it. If silver got too cheap, the algo bots would sell gold to buy silver. So gold is acting as the big brother, protecting the little brother from the bullies. Now, let's look at the dealer premiums here in the West. If the paper price drops, but premiums don't, the physical market is telling you the metal is still wanted. I checked the major dealers. Premiums did not collapse. Inventory did not flood back onto the shelves. Usually, when price spikes, people sell their old coins back to the dealer. But today, the dealers are reporting more buyers than sellers. Even at $75, the public is buying. They are chasing the momentum. This means the secondary supply, the scrap market, is not functioning as a brake on the price. People are hoarding their silver because they think it is going to $100. And they are right. If the public refuses to sell, and the mines refuse to sell, and the banks are forced to buy, where does the metal come from? It comes from the price going higher. It has to go high enough to break the psychology of the hoarder. $75 didn't do it. Maybe $100 will. We also need to consider the tax loss angle one last time. Today is the absolute last day to book a loss for the 2025 tax year. If you bought miners at the highs, or if you bought silver at $83, you might sell today just to get the tax write-off. This creates non-economic selling. People are selling not because they want to exit, but because the tax code incentivizes it. Tomorrow, that incentive is gone. In fact, the incentive flips in January. People have fresh tax room. They can buy without worrying about the tax bill for 12 months. So the tax headwind becomes a tax tailwind on Friday morning. So where do we stand? We are bruised. The chart is messy. But the thesis is unbroken. The banks made a mistake by pushing it this low. They thought they could break the market. Instead, they just cleared the leverage. They reset the RSI. They cooled off the sentiment. They gave the bull market a second wind. We were getting overheated at $83. Now at $71, we are oversold. From a technical perspective, this is a much better place to launch a rally from. The fuel tank has been refilled. So what happens next? We need to look forward to the first 48 hours of 2026. While the banks are catching their breath after the GSIB squeeze, a new giant is waking up. The pension funds. We have talked about the January effect before, but now the setup is locked in. The year is closed. The data is final. Silver was the best performing asset class of 2025. It beat the S&P 500. It beat bonds. It beat real estate. This creates a mandate for institutional investors. Pension funds and endowments operate on strict rules. They chase alpha. When they come back to the office on Friday, January 2nd, they have a fresh allocation of capital to deploy. They look at the leaderboard of 2025. They see silver at the top and they ask, do we own enough of this? The answer is almost always, no, we own zero. So the great rebalancing begins. Trillions of dollars of passive capital will start to rotate. They will sell a little bit of their overvalued tech stocks. They will sell some losing bonds, and they will buy the winner. They will buy silver. This buying is fundamentally different from the bank buying we saw today. The banks bought to close a short. They were neutralizing a position. The pension funds are buying to open a long position. They are accumulating. They are taking supply off the market and locking it away in a vault for 10 years. This removes the float. When you combine bank short covering with institutional long accumulation, You get a 1-2 punch that can send the price vertical. We effectively cleared the sellers out of the way just in time for the buyers to arrive. The path of least resistance is wide open. Let's look at the yearly candle. Technical analysis works on different time frames, daily, weekly, monthly. But the most powerful signal of all is the yearly chart. We just printed a massive green candle. Depending on the data feed, it is likely a Marubozu candle, opening near the low, closing near the high. This indicates total control. The bulls own the year. For a trend-following algorithm, the robots that manage sovereign wealth funds, this is a buy signal of the highest order. It tells the robot that the long-term trend has shifted from bearish to bullish. These robots move slowly, but they move mountains. They will be programming buy programs for the entirety of 2026 based on this single candle. And we are buying into a shortage. Silver is not just a monetary metal. It is a strategic industrial input. Solar uses it for conductivity and reliability. EVs use it in power electronics, contacts, and charging systems. Data centers and electronics use it in connectors and high-performance components. The grid upgrade cycle uses it in switching and control systems. Demand is not a meme. It's embedded in the hardware. Now look at supply. Most silver supply comes as a byproduct of other mining. Copper, zinc, lead, gold. That means silver production doesn't respond quickly to price. If silver doubles, it doesn't instantly double mine supply. The pipeline is slow. Permitting is slow, capex is slow, ore grades decline, politics intervene, so deficits matter. When the world consumes more than it produces, inventory gets drawn down. When inventory gets drawn down, the system becomes fragile. We also need to consider the geopolitical calendar for 2026. The debt ceiling fight starts in February. The BRICS currency summit is later in the year. The US elections are coming. The macro environment is designed to create uncertainty. And uncertainty is the fuel for precious metals. The banks know this. That is why they were so desperate to close their shorts today. They know that holding a short position into 2026 is suicide. They de-risked. And by de-risking, they admitted that the bear case is dead. They're no longer willing to bet against silver. If the banks won't bet against it, who will? Nobody. That is why the price is rising. The short interest is evaporating. Let's talk about market depth. On December 31st, market depth is thin. But on January 2nd, liquidity returns. Usually liquidity dampens volatility. But in a shortage, liquidity reveals the truth. When the full volume of the market returns, we will see the true depth of the order book. I suspect we will find that the sell side is hollow. There are no large blocks of silver for sale until we hit 80 or 85. The market will have to gap to find liquidity. So do not be surprised if we see another gap up on Friday morning. The momentum is too strong to stop. This is why I call 2026 the year of the squeeze. The buffers are gone. In 2024, we had inventory in London. In 2025, we had inventory in the COMEX. In 2026, we have nothing. The registered inventory is effectively zero. The eligible inventory is in strong hands. The mines are flat. The demand is vertical. This year, the market has to find a price that destroys demand. It has to find a price that forces Samsung to stop building batteries. It has to find a price that forces you to sell your stack. We know that price is not $75. It is likely not $100. So the market has a lot of work to do. It has a lot of distance to cover. This means 2026 will be characterized by violent upside. We will see days where silver moves 5. We will see weeks where it moves 20. This is what happens when a compressed spring is released in a vacuum. There's no resistance. There's only velocity. On Friday morning, January 2nd, the pension funds we talked about actually pushed the button. They have their new allocations. They have their new budgets. And they are looking at a chart that just closed at all-time highs. What happens at 8 a.m. Eastern Time on Friday? We're likely to see a gap up. The momentum from today's close will carry over. The algorithms that buy strength will be active. The shorts who didn't cover today will be desperate. We could see silver open at $77 or even $78. If this happens, do not chase it with leverage. Gaps are volatile. But understand what the gap represents. It represents a shortage of sellers. Nobody wants to sell the first day of the year. Everyone wants to buy. That imbalance forces the price to teleport. Let's look at the specific technical targets for the first week of 2026. We use Fibonacci extensions to predict where the price might pause. We measure the move from the breakout at $50 to the consolidation at $65. The first major target is the 1.272 extension that lands squarely at 85. This is not a random number. $85 is the level where the algorithms will likely take their first breath. They will buy aggressively until we hit that mark. So if you're watching this screen on Friday, January 2nd, do not be surprised if we gap up and run straight toward $80. The magnet is powerful, but there's a secondary target, the psychological century, $100. In a runaway market, a parabolic market, technical resistance levels often get blown away like tissue paper. The market ignores $85 and goes straight for the triple digits. So here's your final strategy. It is easy to buy. It is hard to hold. When silver hits $80, you will feel like a genius. When it hits $90, you will feel like a god. And when it drops back to $80, you will feel like a fool. You have to detach your self-worth from the price. You're not a genius when it goes up. You're not a fool when it goes down. You are a custodian. You are holding a strategic asset that the world needs. Your job is simply to keep it safe until the market offers you fair value. Fair value is not measured in dollars. It is measured in what you can buy with it. Can you buy a house with your stack? Not yet. Can you buy a farm? Not yet. Then the trade is not over. Do not sell for lifestyle money. Sell for dynastic money. That is the goal. The regulatory squeeze of December 31st was the catalyst we needed. It forced the banks to show their hand. They are weak. They are trapped. They bought the high. We are entering the new year with the wind at our backs. The trend is up. The fundamentals are screaming. The technicals are perfect. This channel exists to guide you through that storm. We don't just report the news. We refine the truth. If you found value in this breakdown, please hit the like button. It helps us break through the algorithm and reach more people who need to wake up. And if you want to be alerted the moment the next margin squeeze happens, make sure you subscribe and turn on notifications. Thank you for watching The Financial Alloy. Stay strong, hold your position, and I will see you on the other side of the squeeze.